I'm in agreement that we haven't reached the bottom in Bitcoin yet. It doesn't mean we're not going to get bounces. And I think sentiment is somewhat on the bearish side right now. So we may have a short-term bounce coming in Bitcoin, but I don't think the bear cycle is over for a couple reasons. Number one, you have the stock market that I don't think has bottomed. The US is kind of moving towards a recession. We know there's generally a global recession on the horizon as well. So all of these things will take money away from people that would normally maybe invest some in Bitcoin. So you have those metrics going on. In addition, past cycles, Bitcoin's always corrected 80 to 85%. We've only dropped about 70 to 75%. So you would think that there'd be a little bit more downside. And in addition, I don't think we've seen a full washout. One of the comparisons I drew before with the dot-com era in the late 90s and early 2000s, you really saw this nasty washout. And we really haven't seen that. You've seen some projects go bankrupt. We know Celsius and a few other things, but you haven't seen a real major washout yet where you've demolished and a lot of coins have gone to zero. And so I think you still have to see that full washout, which is actually very, very healthy for the market. It's what you want to see if you're a long-term believer in Bitcoin like myself. Now, in terms of a worst case scenario, so my general target, my best case is 12 to 13,000. That's where I think the best case would be. My worst case, unfortunately, would be 3,500, which would put it in alignment with Amazon.com's .com collapse. So in 2000, Amazon.com topped out in the .com era, and it collapsed 95%. And so if Bitcoin were to do that, it would put it around 3,500. That would be the worst case scenario. So I'm not sure if that'll happen. So in October, at least for us now, I'm actually slightly bullish near term, but going out 4 to 6 months, I do think we head back down. I think by mid 2023 to the second half of 2023 is when Bitcoin would bottom out per the last few cycles. And I think you'll see that coincide with the global stock markets having another leg lower once they see that we are in a global recession. And then the biggest question for me is that in past recessions, in past tough market times, the central banks have always come out and printed money. With the US now having a higher inflation rate, it's very hard for them to print our way out of a recession. And so if the Fed can't print us out of this next recession, it means it's going to be a long, drawn out recession. And that's going to be really tough for the financial markets to handle. And I think the kicker here is, past recessions for the last 20 years, whenever we've gone into a recession, the Fed has started quantitative easing, which is printing money or lowering interest rates. We're going into now a new type of recession we haven't seen in a long time, where we have the high inflation. And we know that if they start lowering interest rates and printing money, then inflation is going to go even higher. So it's going to make the Fed unable to get us out of this recession, which I think keeps us in recession for a longer period than normal. You basically have this scenario where the Fed has kind of been the rescuer, the one coming to the rescue of the financial markets every time we go into a tough period. And they just won't be able to this time, at least not as early on as the markets would like. Something that happened in 2008, 2009, as we know, with Lehman Brothers, and basically when financial markets get extremely stressed, a lot of the derivatives credit markets, they start to freeze up. And it makes it very hard for banks to get liquidity and kind of stay functional. And that's what you're kind of dealing with Credit Suisse, Deutsche Bank, and potentially other banks as well. Now, right now, I don't think there's a real risk of those banks going under, because I think the Federal Reserve and the central banks globally will try to help them out. But it is a warning sign. To me, it's a big shot across the bow, where you have to start saying, all right, there's trouble here brewing, and investors need to be really careful here over the next 6 to 12 months, because it is telling us that there are problems in the system, that when the Fed's not actively pumping money into the world system, you're going to have breakages. So in terms of fiat money, I think it's always smart to keep some money at home, just in case you go to the bank and the bank is closed down, or there's a grid failure or something like that, where you can't get anything out. Right. Yeah, exactly. Anything like that. So I don't have a lot, but I have kind of the emergency, amounts. And then I also am a big believer on having some gold and silver on hand, because again, even if you run out of fiat currency, or let's say the dollar collapses or any currency collapses, gold and silver should hold their value. And you could always, go buy something with a little piece of silver or something like that. So I think it's investing is all about figuring out the different risks and then kind of plugging those holes. So, you think about banks shutting down. Okay, well, I should have some cash on hand. You think about the dollar collapsing. For me in the US, I need to have a little gold and silver on hand. And it's all about kind of mitigating those risks. I've been a big fan of gold all year long. I mean, the dollar has been so strong that it's kind of put pressure on gold, but I'm a big fan of gold. I think, again, even though the Fed is going to resist printing money for a couple years, eventually they will have to, and they're going to be forced to, because things will get so bad in the global and domestic economy. And so the gold price is going to be one of the key values that I think will hold your value, whether you're in, any currency, frankly. I also think that eventually Bitcoin becomes a screaming buy. Once it bottoms out, I do think it has a pivot, and that will absolutely, be a storage of safety for you as well.